Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today I'm joined with Scott Kyle. How you doing today, Scott?
I'm doing great. Thanks, Kirk.
Good. Well, glad to have you, and brought Scott on. We're talking about a topic that's near and dear to my heart today. But Scott, why don't you tell us a little bit about your background?
Sure. Yeah, I was raised in the Midwest, East Coast educated, and then eventually landed here in La Jolla, California, where I've been for nearly 30 years. My dad handed me my first investing book in high school back in Chicago. I really fell in love with the idea of investing, had the opportunity to meet Warren Buffett at business school, and decided I want to dedicate my life to helping others make smart financial decisions. We're really not wired humans to make good financial decisions because we often do things based on emotion rather than fact. And so what really resonated with me was the idea that Warren Buffett said, temperament is the most important characteristic to be a good investor, a good financial advisor or money manager. So I happen to be born with the proverbial Vulcan ears, have the ability to set emotions aside and really just make smart decisions on behalf of my clients, based on objectivity rather than emotions. And I'm very fortunate. I've been doing this for nearly 30 years and I love what I do.
Nice, nice. So, when I think about portfolio investing, everyone's got their thing, right? And so what would you say your style or how do you think about portfolio construction and investing?
Yeah, like you said, there are many ways to achieve goals, whether it's investing or other areas of life. Whether it's losing 100 pounds, there are lots of ways of doing that, more exercise, less food, some combination thereof. And with investing the same way, there are different ways of achieving goals. So the most important thing is to know thyself, know your circle of competence, and stick within that circle of competence. Now, hopefully that circle of competence is something that can do well in various market conditions and not just be only favorable in certain environments. So our style and my style, which is really a Warren Buffett style, is buying high quality blue chip companies first and foremost. So understanding what you own, buying really good businesses. In some cases, they're dividend paying companies like a Johnson & Johnson or others similar to that. But we're also open to buying good quality growth companies, the Googles and Amazons of the world. And then, basically just making sure that you're investing consistent with your goals. If you don't need the money for 5 or 10 years, you should be mostly in stocks. If you need the money to pay for lunch tomorrow, you should be in cash. Regardless of whether in a bear market or bull market, just make sure you have the right asset allocation. And then if you avoid certain basic mistakes, you're probably going to have a successful outcome. Then another tool that we use that we talk about in the book, The Compound Code, is using options as well. I'm sure we'll get more into that later in the conversation, but that's just another tool to help achieve a few goals like increasing income, reducing volatility, doing some hedging. So at the end of the day, just like with health, you've got to know where you are today, what are your goals, and then what are the best tools to get from point A to point B.
So you mentioned allocation. I think this is a big point of contention with a lot of people is when it comes to allocation, there's a long held truism in air quotes of the 60-40 portfolio is one of the better long-term approaches, but last year that didn't hold up. So what are your thoughts on how people should think about allocation, when you have a year and maybe more where stocks and bonds are positively correlated instead of negatively correlated?
Sure. Yeah, there are many important rules, or I should actually say a few basic rules of investing. And one of those rules is make sure you're matching your asset allocation with your time horizon. So again, as I said before, if you need the money in the near term, and I define the near term as next year or two, then you should be in something more stable, like a fixed income or cash. If you don't need the money there's no magic number, but call it 3 years or more, then you should be primarily in stocks. And then there's, of course, the in-between. So just like with health, if you're 20 years old and trying to train for a marathon, what you're doing is very different than if you're 95 years old and dealing with heart conditions. So when it comes to asset allocation, if you're in your 20s, 30s, 40s, or have a very long time horizon, then there's really no reason to be in fixed income, or certainly not 40% fixed income. Whereas if you're in retirement and you're drawing from your funds, especially now with interest rates being higher, you might want to be 80 or 90% fixed income if you're in your 80s or 90s. So the idea of a 60-40 never made sense to me at all, let alone, in markets where, like you said, with correlations being aberrational as they were last year. So I would say, you first and foremost understand what your time horizon is. And if you don't need the money for, call it 5 years or more, that money should be primarily in equities. And if you need money in the near term, that money should be primarily in fixed income. For some people, that might be 100-0 in favor of stocks, and other people might be 100-0 in favor of bonds. So it's really specific to everyone's circumstances and time horizon.
Do you take into account kind of like macroeconomic conditions? Because obviously that plays a lot into portfolios. The market's expensive, it's cheap. Like, how do you overlay that into normal portfolio construction?
Yeah, well, we're typically buying individual stocks. So at any point in time, there's the overall market and overall market valuation. I've been doing this long enough to remember, back in the late 90s when stocks, even high quality companies like Microsoft and Coca-Cola, otherwise great companies, were bad stocks. Why? Because their valuations were so extreme. They're trading at 40, 50, 60 times earnings. And again, I'm not talking about these like meme stocks or SPACs or what have you. These are just high quality blue chip companies trading at very, very high PE ratios. So at that point in time, the stocks were very expensive, and therefore the likelihood of good returns over the next decade were low. Then you have other periods like in 2009 where PE ratios were much lower, and the prospects for returns were much higher. So it's very much important. It is very important to look at valuations, and you've got the overall market valuation like the S&P 500, but then you've got individual stocks. So even though, for example, in 1999, the overall market was trading at a very high PE ratio, that was driven by a handful of stocks. And there were many sectors like small cap value or large cap value or international that were actually trading very favorably. So you do need to look at the overall market valuation, but there are typically pockets, whether it's a particular market cap size or a sector or an individual stock or geographical area that can be far more attractive than the overall market. And then to your question of macroeconomics, again, I've been doing this a very long time. The reality is that it's extremely hard to predict short-term macroeconomic variables, and very difficult to then determine how the market's going to react to those. And therefore, like Warren Buffett said, he spends 5 minutes on economics every year, and that's 5 minutes too much. So I would focus really more on portfolio construction, buying high quality companies, having the right asset allocation for your time horizon, and then the rest will take care of itself. The only caveat I'd say to that is there are certain types of companies in certain industries that do better in certain market conditions, with interest rates being higher or lower, what have you. So that can help to drive your specific stock or sector selection. But what I wouldn't try to do is time the market based on someone's prediction of a recession. If you had done that, the last year, 2, 3 years, there are plenty of smart people predicting a recession. It hasn't happened, and it may not happen for a while. So you'd be, like Peter Lynch said, far more money is lost waiting for something bad to happen than the actual event itself. So just be very careful about trying to time the market based on unpredictable macroeconomic events.
Yeah, I think that's good insight. So, a lot of people have different styles. If you think about like growth versus value, you had mentioned, a lot of large cap blue chips. And then you mentioned dividend stocks. So would you say more value oriented or growth oriented or both? Or how would you describe it as a construct?
Yeah, as a financial advisor, we have clients ranging from 2 months old, being the kids of clients with 529 plans for college, for example, all the way to, I think our oldest client is 96. So every client has a different time horizon, a different goal. So if, for example, a client is younger and has a long time horizon, let's say they're just starting an IRA, they're in their 20s or 30s, then for them, in their particular circumstance, they don't need income, and they're really focused on capital appreciation. So in that particular case, we would focus more on small cap stocks, growth stocks, because that's appropriate for their particular circumstances. They're literally not going to touch the money for decades. They don't need any income, and therefore that's how they should be invested. We have other people who are living off their assets. Maybe they sold the business and they've retired, or they're in retirement, and they need income literally to pay their bills, to pay their mortgage, to to go for on a nice vacation, whatever it may be. So in that case, having dividend paying stocks, as well as some covered calls, which can help to generate even more income, can be appropriate for them. So we're style agnostic. There's plenty of great growth companies, plenty of great value or dividend paying companies. The key for anyone, again, is applying the particular type of investment to their circumstance. It'd be just like if I were a personal trainer and someone said, do you prefer the treadmill or the weights? Well, if someone's training for a marathon, I'm going to tell them hop on the treadmill. And if they're trying to set a new personal best in the bench press, I'm going to say, let's hop on the weights and try to get strong and build some muscle. So there's, in general, if you're just trying to build a general portfolio, having some growth and having some value or dividend paying stocks is probably the right way to go. Because, like last year, value did very well. The Bristol Myers of the world did very well and growth got killed. This year, the opposite is occurring, despite many smart people saying, hey, focus more on defensive value stocks. They haven't done well. It's very hard to predict in the near term what's going to be in favor. So first and foremost, let your particular objectives drive the allocation and the type of investment you have. And when in doubt, just have a well-diversified portfolio with a bit of both.
Yeah, I completely understand your sentiment. I think it's hard for a lot of people to have a growth and or value perspective. I think most people are either growth and momentum, or they're value and more stability. I mean, I tend to favor more on the value side because I like buying things cheap. So, looking at the environment that we're in economically, as you said, you have to have a little of both. But do you have an opinion about looking at the environment we're in as to which style would be a better approach in this market, or how do you look at that?
Yeah, again, we're really looking at individual securities. So within growth, there are some compelling valuations, some compelling stocks within growth, and there's some that are just way overvalued. And so I would say, to the extent that you have a growth orientation or want to have growth within your portfolio, look for the more attractive growth names. And then within the value space, same thing. That said, so if you're looking like literally today and the environment, a lot of really high quality value companies have gotten beaten up. So we tend to be contrarian and value oriented, meaning that we're looking at the stuff that isn't doing well at any point in time. Last year, when growth was getting really beat up towards the end of the year, we were adding some high quality names like some Amazon and Googles that were down 40 or 50%. And people were writing them off as, hey, their best days are over, even though Amazon has dropped 50% or more 12 or 13 times during its public life. So that's when we were adding those kinds of securities. And getting out of some of the value stocks that had done very, very well. Now the opposite is in place. Bristol Myers is down, I'm just using it as an example, but there are a lot of great value stocks, some financials, pharmaceuticals, they're down 20, 30, 40%. They're still great companies. They're just sort of out of favor. And so we would tend to, again, not go all in, but sort of weight more heavily those value stocks that have gotten beat up and maybe hedge with options are growth stocks that have done very well so far this year.
Okay. Yeah, we'll get to options in a minute. How do you make your determination of whether something's a good value? You mentioned Bristol Myers, and looking at it off the peak, it's down quite a bit. It's not down 50 yet, but maybe 40%. So, but the valuations across the board are sky high everywhere. So, how do you determine proper valuations for the positions that you purchase?
Yeah, we're looking at a few metrics. So we look at both the overall market environment, and then we're looking at the company-specific metrics as well. So that could be, for example, they may have a PE ratio range historically between 12 and 25, for example. And so if the stock itself is trading near the lower end of its range, then that would indicate more favorability in terms of being attractive for the returns going forward. We're also looking at things like the dividend yields. So stocks sometimes trade within a range of dividend yields. So for example, maybe the range is 3% at the low end to 5% at the high end. By mathematical definition, if it's close to 5%, that means it's beaten down. And often there are floors relative to the dividend payouts because it becomes more attractive. So if the PE ratio is lower and the dividend yield is higher, then that's going to be a more compelling valuation as opposed to a company trading at the high end of its PE ratio and the low end of its dividend yield range. So there's that, and there's of course other more detailed metrics like particular ratios around the balance sheet, things like that. But we're generally, again, buying companies that have been profitable and paying dividends for decades upon decades, that have reasonable payout ratios, that aren't at risk of cutting their dividend anytime soon, because companies do cut dividends from time to time, and that are favorable from a PE and a dividend yield ratio.
Okay, cool. So you also mentioned options, which we've had some people on the show in the past talk about options, but how do you utilize options as a part of a portfolio strategy?
Yeah, we look at really 4 profit centers within someone's portfolio. You have fixed income, so that would be interest income, whether it's on a money market or treasuries or wherever their bonds are. Then you have dividends, to the extent you have dividend-paying stocks. You have price appreciation, which if you buy at a reasonable valuation and you have the right time horizon, you're likely going to get over time. And then you have the sale of options. Let's use covered calls as an example. A covered call is simply buying a stock long. Let's use Bristol Myers, and then selling a call against that at a particular strike price. So if you buy a company at a price of 60, you could, for example, sell the calls at 65 and generate some income. Typically, we can generate anywhere between 2 and 3 times the amount of the dividend in the form of options premium. It just depends on the strike price and volatility and a few other variables, but you can really enhance the dividend income through the sale of options, which also provides some volatility reduction in the portfolio, as well as a bit of downside protection. So of those 4 profit centers, as it were, the most secure would be the option sale, because you get the cash credited to your account, and then just over time that gets earned out through time decay. The second most secure would be the fixed income, again, assuming you buy the right types of bonds. The third most secure would be the dividends, assuming you buy the right kind of dividend-paying stocks. And the fourth most secure, especially in the near term, would be price. So we're looking at some mix of those 4, depending on the client's goals and objectives. If, for example, as I said before, the client has a very long time horizon and they don't need any income, then we're focused almost exclusively on price appreciation. It doesn't mean we won't own some dividend-paying stocks, but we're not owning the dividend-paying stocks because they need the income. We're owning them simply because they're just good stocks, and they'll likely do well over time between the dividend and the price. If, conversely, the person really is focused on income, there's going to be a mix of fixed income, dividend-paying stocks, and options, and really with the goal of generating as much income as possible for the client. So we're really looking at the mix of those 4 tools or profit center and applying it to the client's particular circumstances.
Okay, nice. So also, you mentioned here in one of your things earlier about shorting stocks. Is that something that you do for people, or what do you think about that?
We can, yeah. I cut my teeth in the hedge fund world out of business school, so I'm very familiar with various hedging strategies, including shorting stock. I would be very careful. By definition, the gains are limited to 0 from whatever the price is to 0 in shorting a stock, and the losses are unlimited. Plus, stocks tend to go up over time, so one needs to be very careful in terms of shorting stock, because you can be right eventually, but not around to see how right you were if you have to get out of the trade because it's working against you. Also, people think about shorting based on valuation, like, hey, Amazon's overvalued, let me short it, or Netflix is overvalued, or Nvidia is overvalued, let me short it. Shorting based on valuation, again, is very dangerous because something can stay overvalued for a very long period of time. I mean, Amazon's been trading over 50x earnings for 20 years, right? So if you went long Walmart and short Amazon as a pairs trade 15 years ago, you would have lost a lot of money. So if you're going to short, it really should be more of a situation like, hey, this company's broken, or there's a fraud situation, or there's a specific event. And then, but that said, certainly one can short. You could, for example, short the overall market against your longs as a way to create a more neutral portfolio. So let's say, just to put some structure on it, you've got $1 million and you have $900,000 of what you think are really good stocks. So you're long 900,000 or 90% of your portfolio. You could then short other things to make the portfolio neutral, such that you don't care if the market goes up or down. You just want your longs to go up more than your shorts go up, or have your longs go up and your shorts go down. So you're betting more on the direction of individual securities as opposed to the market itself. And you can do that, create a market neutral portfolio, or one that's slightly long or even slightly short. You can also, just like you can buy a stock long and sell a call against that to hedge that long, you can short a stock and sell a put against the short to hedge that short. So just like you'd cap your upside when you buy a stock long and sell a call, you'd also cap your upside on the short by selling a put, but it's a way to hedge your short, just like you might hedge your long. So I know I threw a lot of information out there. Bottom line, stocks go up over time. Unless you do this for a living, really shy away from shorting stocks. It's too dangerous. It's too time consuming. There's too many costs associated with it, borrowing costs, etc. And you've got the trends are just working against you, right? If you're trying to make some money, just buy good quality companies, earn the dividends, and go live your life.
Yeah, I think that's a good perspective. Cool. So I guess one final thought here I'll ask you is, let's say you had a thesis that we're going to recession, which of course we can't predict the future, but everyone tries, right? So how would you prepare for a time period where things are, let's say, well, the environment that we're in, where everything's overvalued and the upside may be limited and the downside might be significant? Would you change around the portfolio construction in light of that, or you just kind of ride it out?
Yeah, again, I will certainly, go through the analysis, but I just want to point out that super, super smart people, well-intended people who really have nothing to sell have been predicting recession now for 2, 3, 4 years. And so the caveat to my answer is it's extremely difficult to predict macroeconomic indicators. I mean, if we had Jerome Powell on this call right now and someone put a gun to his head, he couldn't give you an answer as to if and when we're going to be in a recession. He simply couldn't. They're literally hundreds of millions, if not billions, of variables that go into that. And I've been doing this long enough to know that the economy can just surprise people, let alone the market's reaction. That said, if you have a thesis and you have conviction that this time there will be a recession, whenever it may be, first and foremost, remember that the stock market tends to anticipate somewhere between 6 to 9 months macroeconomic events. In other words, it's likely going to decline long before the recession's ever made official and rebound around the time that people say we're now in a recession. So you have to time whatever you're going to do vis-a-vis the market relative to that recession. So no one rings a bell and says the recession has started. We will find out after the fact, and when it's official, stocks will have likely already recovered. And that's just a statistical fact. So you need to take that into consideration. But again, let's say you knew all of those things, then I would focus more on companies that tend to do well in a recession. I would focus more on dividends. I would focus more on hedging using options to protect against the downside. There's still lots of ways to make money. You just have to be prudent about it and be more defensive. Furthermore, again, if you have a long-term time horizon, let's say 10 years or more, I know it sounds counterintuitive, but short-term declines actually work in your favor, especially if you are either adding money to your accounts directly or through dividend repayments. So some basic math. 10 years from now, let's say the Dow is 35,000 today, whatever it is, 10 years from now, it's going to be about double. It'll be 70,000. That sounds like a big number. All that means it's been up 7% per year on average over the next 10 years, right? So it's going to be somewhere about double in 10 years from now, plus or minus. No one knows where it's going to go day to day or week to week or year to year between now and then, but pretty good likelihood it's going to be somewhere around double. The question is, would you rather have it go double tomorrow and then stay flat for 10 years, go up exactly 7% per year to make that double in 10 years, or go down a bunch in the near term and then towards the end go up to whatever it's going to be 10 years from now? Well, to the extent that you're adding money to your portfolio or reinvesting dividends, you're better off with short-term declines. Why? Because you're you're buying more shares at a lower price, either through dividend reinvestments or through just your adding to your 401k, et cetera. Furthermore, the companies you own, like Apple and ExxonMobil and others, they're buying their shares back. You'd rather that they buy them back at a lower price than a higher price. So I know emotionally, psychologically, it seems like, oh, it's a bad thing. Stocks are down in the near term. And indeed, if you're a retiree, pulling money out, it would be, but hopefully that money is in fixed income, not in stocks, right? You've done your proper asset allocation. But for those who have equities for the long term, these near-term declines driven by recession or terrorist events or politics or whatever it is, whatever the headline of the day is, it actually works in your favor as long as you don't sell on weakness and make one of the biggest mistakes, which is to get out of the game, even though you don't need the money. So yeah, you can predict the recession. You can try to get into defensive stocks. You can focus more on dividends. You can hedge and all those things. But at the end of the day, if you have the long-term time horizon, it just doesn't matter. Or more accurately, you're better off having stocks go down in the near term relative to what your long-term goals are.
Awesome. Well, Scott, I really appreciate you coming on the show and sharing your wisdom with us. Final thoughts from you, and where can people find more about you?
Oh yeah, no, I appreciate it. Thank you, Kirk. Yeah, the name of the company is Coastwise Capital Group, coastwisegroup.com. The book that Patrick and I wrote is called The Compound Code. It's available on Amazon. Most importantly, we love what we do. Happy to share our thoughts with folks on a one-on-one basis. Not a sales guy. I've been an investor for 40 years. I've been a salesperson for 0 years. So just very fortunate to have a passion for investing, and really appreciate the time to be on Money Tree.
Awesome. Well, Scott, once again, appreciate you coming on the show, and yeah, we'll have you back in the future.
Sounds good. Thanks, Kirk. Have a good day, everyone.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right. Well, that was a great interview with Scott. Really appreciate him coming on the show. And now we're into the panel portion of the show where we have our very own Barb Friedberg. Hey, Barb.
Hi, happy to be here.
Glad to have you. And we also have our very own Phil Weiss. Hey, Phil.
Hey, Kirk. Thanks for having me today.
Yeah, thanks for coming on. So let's dive right in. So, Barb, what were some of your takeaways from the interview?
There was a lot. He's a stock picker, which brings me to the topic of stocks versus ETFs or mutual funds and pros, cons. I think that's worth talking about. Selling call options to generate income. Is that worth it? Is it not? Do you have to be a pro to do it? How to do that? So those were two of my main takeaways, as well as asset allocation. What's the right mix of stocks and bonds for your portfolio?
Great. And Phil, what about you? What are some of your takeaways?
So I can echo the points that Barb raised. I also thought that he might have been a little extreme in some of the cases on the asset allocation, but also like his comments, which I generally agree with, about not placing too much weight on the macro, the fact that we can't forecast and see the future. Like I thought those were all worthwhile things to think about as well.
Nice. Well, let's start with this, because I know we had a great outtake session here prior to the show. We were talking about this, but let's dive into asset allocation, because I think this is fun. Well, maybe a little bit more of a coffee talk session here, but you know, what are your both thoughts about asset allocation? Let's start with you, Barb. Like, what do you?
I was thinking about the markets yesterday, and we're in mid-November yesterday, and we had some economic news that inflation is slowing down, and the markets went insane. On my portfolio management tool, I was looking at best performers. I had a small cap go up 4%. I had the S&P 500 go up like, almost 3%. Everything was up. Everything was up more than 1%. And I was like, this is a freaking amazing day. But what it said to me was, boy, what if I'd missed this day? What if I was out of the markets yesterday when there was so much growth? So how does that relate to asset allocation? Well, it relates to asset allocation because you cannot predict what days are going to be good for stocks and bonds and whatever else you have in your portfolio, and what days are going to be bad. And that's why we talk about having a balanced asset allocation for the long term. And what that simply means is a mix of stocks and bonds, and possibly some alternatives or others as well, because stocks typically go up over the long term. Most days, most weeks, most years, they go up, and they go up nicely. Average 9-10% on the stock market over the last, decades and decades. So you want to have a good portion of your investments in the stock market. Now, every day isn't going to be like yesterday with like mind-boggling upswings. You're going to have days where stock market goes down 1% or even more, or you're going to have months where you lose 5% in the stock market. So I will echo what Scott said, is investing is for the long term, 5+ years, and then you drive your asset allocation based on how much risk you can handle. So while stock markets goes up very nicely some days, it also goes down. And during the years it goes down, we've had quite a few years where it's dropped 30-40%. Now, if you can handle that and you're a long-term investor, then you can afford to have quite a bit of your assets in stock or in stock type assets. But if you need a little more stability in the pricing of your stocks and bonds and your total investment portfolio, then you want to have a little more in your bond assets. Also, if you're going to need the money sooner rather than later, then you don't want to be too heavy into stocks, because you don't want to have to be drawing from your overall portfolio after the stock market dropped 30%.
So Phil, that's great, Barb. Phil, what about your thoughts? What are your thoughts on allocation, portfolio construction? How should people be thinking about it?
So I think that all those things that Barb said are important, but I'm going to add one more thing. And that's something that I talk about a lot with my clients, is the idea that we don't have to go chasing the best return. We want to construct a portfolio that allows us to live the life that we want. So chasing the biggest return means taking on more risk, which means if you think about your asset allocation, typically more risk means a higher allocation to stocks, because stocks, while they have the potential to go up more, they also have the potential to go down more than bonds over the long haul. So don't take on more risk than you need to, because the last call I want to make is to clients, well, we took on too much risk. your portfolio underperformed, and now that big trip that you wanted or something else that you wanted to do in the future, you can no longer do it. We want to make sure that when we think about all this, think about your emotions and how you can handle it. Because I always think that the two worst things that we can do as investors is buy high and sell low. I have a client that she wanted to she bought an additional apartment that she wanted to combine with hers. And she had all the money to do it in the stock market. She left it there. Now she's ready to do the work. But unfortunately, the value of the mutual funds that she had in that account are half. So now she doesn't have the money to do it. When you have money that you're putting aside for near-term needs, it doesn't belong in the stock market. It belongs in something that's highly liquid, that's not subject to risk, because you don't want to end up in that situation where you can no longer do something. So you want to make sure that you think about what the money's for, what it is you're trying to get to. We don't have to just sit there and keep building the biggest portfolio. You have to think about why we're doing it and where we need to get, instead of saying, I got 1 million, now I need to get to 2. Now I got 2, I need to get to 4. Like, it doesn't have to work that way. Think about what you need. I think that's really important as part of the process.
Yeah. No, I think those are great points. One thing that kind of comes to mind is, I think these are all good rules of thumb, but the reality can sometimes be different, right? And the markets change, and certainly if you need the money in a year, you shouldn't be all in equities. That's just dumb. But I think in terms of allocation, generally speaking, once you get out a certain point, there's certainly a lot of back and forth as to what's appropriate. I think a lot of people have gone 80-20, 60-40. They've all got their opinions, but I'm curious on each one of your opinions, because before the show we were talking about this, and I actually have a very different opinion than I think both Barb and Phil. But what are your thoughts on the 60-40, 80-20? Like, what's the research say? What are people talking about now, Barb?
Well, there was a lot of stuff recently when bonds have underperformed and bonds were delivering 0% returns, and then they were negative returns. And everyone was saying, oh, the 60-40 portfolio is dead. It's no damn good anymore. Forget it. Throw it out the window. Well, yeah, 2022 was a bad year. We had a decline in both stock and bond prices, but that's like a once in a generation type of return. So pulling in what you said, Kirk, and what you said, Phil, there's little reason to go for the highest returns all of the time for most of us, unless you're 20 years old, you're saving for retirement in 40 years, and then go for it, be 100% in stocks if you want to. But for the rest of us, growth isn't always the best path. Maybe we want some capital appreciation. I'm in the last, sector of my life, the last third of my life, let's say, if I'm being generous. And I want to preserve what I've worked so hard, what our family has worked so hard to earn. So the asset allocation is so personal, and it doesn't have to stay the same. And I also want to throw out something else. Look, I'm 60-40, but I've never liked to see a portfolio drop. So when I was in my 20s, I was 60-40. Now, could I have more money today if I had a higher allocation to stocks back then? Well, maybe, but I sleep at night every single night, because I know myself, and I know, I can handle a 20% drop, not so much a 40. So I'll let Phil talk, but then I want to get back to talking about something else, which is an unusual way to look at portfolio construction. It's called the bucket strategy, but I'll just put a teaser out there. We'll talk about that in a minute.
Yeah. So Phil, what about you? What are your thoughts?
I agree. Portfolio control, it is personal. Like not every client has the same allocation. It's not like I have every client that's 60-40 or everyone that's 80-20. My allocations range from 40-60 at the low end to 80-20 at the high end. But if you're very young, like Barb was talking about in the 20s, like I have some clients that have younger kids that are starting out, they can be 100-0 because they have a long time. And if something goes wrong, at least they have the capacity, much more capacity to make up for it. But I also like to think about the idea that when we're investing, it's kind of like something that Scott said, I just think of it a different way, that we're making an implicit assumption that the market's going up over the long term. So if we have a consistent process that we apply and we diversify, that should lead to long-term gains, because that's what the market's done over the long term. And he gave an example, and I think of it a different way. When the market falls, that's opportunity, right? We often get afraid when the market falls, but it really creates opportunity. Because think about it, if you're putting $1,000 every paycheck into your 401k, I'm just using that because it's a nice simple number, right? And you had 5 shares that were $200, and now they fall to 150, right? So you're down 25%. But if you keep buying, you bought at 150. When we have that 25% increase, that that 6 2/3 shares that you bought at $150 each, they're now going to be worth $1,250. So you got the gain on those, plus your other shares recovered. If you just stopped, you wouldn't have had that other gain. You'd just be back to even. And even worse, if you got afraid and pulled out, now you just have the loss there. So you have to have the ability and the patience to go and invest through the downturns. And when we have a long-term, when we have a lot of time left, and remember, your time horizon isn't just you, right? It may not just be your life. I mean, I have clients that we invest for, they have enough, and it's for their kids, the future generations. So we want to think about that too when we think about how much risk we can take.
Yeah, I have to say I have I certainly have issues with a lot of the with the allocation setups, in large part because we have these rules of thumb in the industry. 60-40 has been great for 40 years. It's the best approach. It has long track record. And I think one of the challenges is it doesn't account for the fact that the last 40 years were a certain paradigm. And that paradigm is interest rates dropped from an all-time, I don't know if it's all-time high, but generational high to a generational low. And so bonds were a safe place to hide. Bonds are safe. And bonds are safe if interest rates are declining. They're not safe if interest rates are going up. And so I think the challenge that people have in looking at the historical norms of 60-40 or 70-30 or whatever it is that they're looking at history saying, oh, well, this has always done well, we're going to keep doing this, right? Or indexing is the best approach, I'm going to keep doing that and not think about why it's the best approach. I mean, we had Rick Ferry on the show, did a great job, love Rick, big proponent of indexing, and he's not wrong, but I think we have to think about why we're doing what we're doing and have the underlying assumptions changed. So 60-40 last year didn't do very well because, bonds didn't do well. I mean, if you were in 30-year treasuries, you lost, I think it was 54% of your value in like 12 months. That's not insignificant if you're looking for safe bonds. And so, that was kind of an extreme. I think treasuries in the 1.25, 1.75, the 30 years were back 2 years ago. So those are generational lows as well. But the point being is you have to look things in a bigger context. So one of the things that I certainly have issue with is people look at bonds as if we were looking at the last 40 years. And it's not necessarily the case. And they're saying, well, bonds, you should have stocks instead of bonds. Well, yeah, but if you're getting 5.5% in your bonds versus stocks that are extremely overpriced, what is your highest and best use of your money? Where is your alpha coming from? And you can put your head in the sand and index and say, well, I don't know the future, so I'm just going to index. That's an approach. But in 2000 to 2013, you basically lost money for 13 years because you stuck your head in the sand. There are times in the market where it makes sense to be cautious and not take the traditional approach. And right now, we seem to be in a place where if you can get 5.5% for virtually no risk with short-term treasuries versus taking some risk and maybe getting 6 to 8% in equities, the trade-off doesn't seem worth it to me. When the downside of equities could be 40, 50% or something like that. So I don't know what everybody's thoughts are. Barb, what are your thoughts on
Well,
this?
I disagreed with you about index funds, but I like what you said, and I'll tell you why in a minute. But I like what you said about the treasuries. And I myself have a ton of money in treasuries, 13 to 26 week treasuries right now, because the returns are so freaking good. You know, like Kirk said, with treasury bills right now, and even the longer term notes and bonds, you're getting historically very good returns, and they're they're protected by the full faith of the US government, which sometimes we wonder, well, how good is that? They're dropping their credit rating, but it's among the best that we've got right now. And treasuries have another benefit, is they are tax exempt state and local. So if you live in a place like Kirk and I do, Massachusetts,
Taxachusetts.
California, what did I say?
Taxachusetts, Barb.
Oh, Massachusetts. I don't know how things are in Maryland, but I do know in California and Taxachusetts over there on the East Coast, we're being taxed out the what. So treasuries are appealing.
Maryland too, by the way.
What? Maryland too.
by the
Okay.
way,
So we're represented. Indexing, look, short term, well, yeah, index funds didn't do great from the first decade of the century, because in the end of last century, 1999, 98, the tech boom drove stock prices up to the stratosphere, and then they had nowhere to go but down. And so they dropped for 3 years. Returns dropped for 3 years in 2001, 2, and 3. And yeah, that set up a bad model for the first decade if you were an indexer. But, very few of us put all of our money in the stock market at the beginning of 2000. And so if you're dollar cost averaging into index funds like the S&P 500 or the total stock market, and you're not pulling money out, this is money for the long term, for your retirement in 10, 20, 30 years, your returns have bested 60 to 70% of all active management strategies. And that's just data. So, Kirk, I'm just saying I am an index fund proponent. And I think if you're not trading and you're not looking at the short term, it's really tough to beat an investment strategy in equities that's going to outperform active management. And that doesn't say active management doesn't work. There are some people that do it well, some people we don't know about that do it well, because why would you brag and give away all your secrets if you're beating the market?
Well, I guess to get back to my point, it wasn't that indexing is good or bad. It's that the people are not mindful of the timing of it. And, if you're indexing and you start in March of 2009, then you're going to have a darn good track record. If you're indexing and you start in January of 2000, you're going to have a very terrible track record, right? Now, of course, we don't know the timing of it. We can't tell the future, but we can tell the probabilities are such that the chances are higher that the market is, if you look at probabilities, the upside is limited and the downside is quite large at this moment. So does it make sense to index and to put your head in the sand and just ignore it? Or does it make sense to reallocate into something like you were talking about, Barb, like treasuries that you're getting 5.5% for virtually no risk? It's hard to argue that point when the equity upside is limited. Now, does that mean you should put all your money in bonds? No. Does it mean you should put all your money in stocks? No. Right. But it's just, I think the people tend to invest without thought. They just do something and forget about it. And I think the challenge that I'm trying to bring to people in the show is to think, right? Start thinking, right? Does it make sense to, if you're an indexer, does it make sense to index today? I would argue that you're missing some major signs that you could take some profits off the table. And, have some cash. So if things do go crazy, you're going to have cash. You can go in and buy cheaper, dollar cost average, if you will, as Barb says, you can buy things cheaper. But if you don't have that liquidity, then you're missing out on a very serious opportunity that could come to pass. It may not, but I find it hard to believe that numbers are going to lie for us much longer. At some point, people stop being able to pay their bills and pay their debt, and that becomes a problem. So,
Well, that also, were you finished before
yeah,
I
go ahead. I was going to go to Phil
run
next,
my
but go
big
ahead.
mouth and
No,
jump
go ahead.
in and interrupt
Please
you
do.
again?
Please do.
And that goes to rebalancing, because rebalancing simply means selling the overvalued assets in your asset allocation and buying the undervalued. And so if stocks have a run up at this time, you've probably sold off some stocks and you've reallocated into your fixed income pool, which can include not only bonds, but cash type assets. So just throwing that out as well. And I mean, I actually do, believe it or not, agree with Kirk that it's also pretty good to have cash regardless, just some cash so you've got room for opportunities. When stuff comes up, you want to be able to buy if we do have a recession or we do have a big market crash, you want to have some cash on the sidelines. So yeah, you can swoop up some bargains at that time.
Well, Phil, what are your thoughts? I know you got some thoughts about this. I'm curious in your 80-20, and you had some thoughts there earlier.
So certainly I'm going to emphasize mindfulness for a second, because Kirk, when you talked about bonds, like one of the things that I think about is it was a historic period, right? We had rates in the 70s that were 15, 20%. I remember my grandparents, they retired because they had these corporate bonds that were paying over 20%, but my grandfather didn't realize they were callable, which meant that the companies that issued the bonds took them back in. And so that income that they depended on went away. But when we look at where rates were and where they fell to, because remember that when interest rates start to go up, as we've seen, bond prices move the other direction. There's an inverse relationship. So when over the last few years, there's a concept called duration, which is used to measure how sensitive a bond price is to changes in interest rates. So it's somewhat equivalent to how long a bond has to maturity. Its duration is somewhat equivalent to that. So if you have a 30-year bond or a duration of 30, if interest rates move 1%, that means the price of the bond is going to move 30%, roughly. So one of the things that I thought of is I went through that for my bond allocation. My duration on my portfolios was 5 to 6 instead of 30. I didn't have those things at the long end of the curve because they were so much more exposed to interest rate risk. So when you're thinking about your allocation, there still is that mindfulness element that you want to think about. What do I want to stay away from? What is it that doesn't make sense? That's a really important part of the equation.
Yeah, couldn't agree more. So, as we kind of get close to wrapping it up here, any final thoughts we can leave the listeners with about this topic? I think, stock picking aside, I think it's not for everybody, for sure. But if you do it right, there could be some generational opportunities that come up in the next few years that could be more beneficial if you're a stock picker than if you are maybe just an indexer. So, Barb, what are your thoughts? And then kind of final thoughts as we wrap it up.
Yeah, I mean, I agree with you, Kirk, but you have to look at valuations, and that's even tough because some stocks, like Scott said, Amazon has had a huge valuation, meaning that the price you pay for $1 of earnings has been really high, like forever. And so picking stocks is tough, but it's not to say you shouldn't do it. There are ways to look, I have a couple of stocks in my portfolio, even though the majority are index funds. And I've got like some 4-baggers, some 5-baggers that have just done really, really well over decades. Then I also had the losers, which obviously I sold. So if you're going to be a stock picker, I suggest don't do it with all your portfolio. And I did want to, before I close, I did want to get back to this bucket strategy idea. And that pretty much just means have some buckets. I don't think it's necessarily a substitute for asset allocation, but maybe an addition to asset allocation. So for example, if you want to buy a house in a couple of years, have a bucket with the down payment of your house in it that you have invested in safe cash equivalents, be they 13-week treasuries or high yield money market mutual funds, so that money isn't going to be at risk for the stock market ups and downs. And then have a bucket if you're age 65 and you're looking to retire and you're going to need to draw from your portfolio for the next 5 years. Have it a bucket worth 5 years of, again, cash equivalents. So you don't have to sell stocks when the stock market declines and you need to take out your $30,000, $40,000 a year to supplement your Social Security. So I am Barbara Friedberg. You can find me at Barbara Friedberg Personal Finance and also on YouTube. I will see you next time. Bye.
Thanks, Barb. And Phil, final thoughts from you.
A couple things. One, I want to talk about cash for a second too. Like one of the things I think about is, especially when you're retired, how much cash are you going to need? And I usually think of at least for the next 2 years. And that's separate from my allocation, that because I don't want to be forced to sell into a bad market and recognize all those losses. So make sure you think it, and that kind of ties into the bucket strategy that Barbara's talking about as well. Make sure you think about what are your needs for different periods. And if you have some things that are going to be needed or have to be paid for, whether your living expenses, a big project, whatever it is, make sure you set that aside first. We talk about stock picking. I do stock picking for some clients. Other clients I don't, and I just use a ETF index strategy. I talk about that with the client, and it's the client's decision. It's not mine, which is right for them, because stock picking, while it can have higher upside, because I have some, like I'm a long-term investor. I have stocks that I've owned for 25 years. I'm looking at my portfolio. I have some 10 baggers and things like that in there. I have some losers too. I'm not saying that I'm a great stock picker. I'm just saying, like, you're going to have some of those things. The longer you hold on to them, if you picked well, the better chance you have to have the ones that go up a lot, but they can also go down. I've had some really bad things that I bought too, but they've taught me lessons. So I know how to hopefully can avoid those things, right? But you have to be willing to take the risk to take those lessons, because if not, it's really not going to be a good outcome for you, right? That's why you have to have a process. Stick to your process, because if you have a process that you follow, it's a lot easier to know, was I just lucky? Or did I at least do something right? If I do the same thing over and over again and I have a good result, I probably did something right. But if I don't do the same thing over and over again, think about your science experiments where you have controls, right? You want to keep something constant, because if you don't really have any way of knowing if what you're doing is contributing or adding any value at all. In terms of me, I work with women experiencing big life transitions, which I know can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm is Apprise Wealth Management. You can download my free ebook at apprisewealth.com/ebook, and you can also sign up for my blog. Thanks for having me today, and I appreciate the discussion, Kirk.
Great. Thanks for coming on, Phil. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.